Welcome to today's Explainer. We're going to be unpacking the absolutely unprecedented structural changes hiding behind the upcoming SpaceX IPO. We'll be using a specific analyst's survival guide to do this. Look, some of the biggest initial public offerings in history are hitting the market right now. But what's going on under the hood with SpaceX? It's completely unique and, honestly, a little dangerous if you don't know what to look for. So, we're going to break down the actual financial plumbing so you can navigate this historic event with your eyes wide open.
Right off the bat, the analyst behind this breakdown hits us with a pretty brutal warning. You are the exit strategy. Now, full disclosure here, this analyst openly shares that he was an early investor in XAI, which was acquired by SpaceX, meaning he himself is an early SpaceX shareholder looking for an eventual exit. He's warning retail investors that if you buy into this IPO without understanding the new, hidden rules, you might be left holding a bag you didn't even realize you bought.
Okay, let's dive right into our agenda for today. Think of this as your step-by-step survival manual. We're going to cover 1. The biggest IPO ever. 2. 3 hidden rule changes. 3. The buy the pop trap. 4. The float multiplier twist. And finally, your IPO survival guide.
Section 1. The biggest IPO ever. Let's understand the sheer scale of this thing.
SpaceX is reportedly trying to raise around $75 billion in cash. Just let that number sink in for a second. $75 billion. That massive figure completely validates the cultural hype around this event. I mean, everybody knows SpaceX, right? We all see the rockets landing. But $75 billion is an absolutely staggering amount of capital to absorb from the public markets in one single go.
To put that scale into perspective, let's look at the previous record holder, Saudi Aramco. They raised about $38 billion in today's money, at a $2.4 trillion market cap. SpaceX, they're raising roughly double that money. So, by capital raised, SpaceX is the biggest IPO in history. Now, it's really important to note that a $2 trillion market cap doesn't make it the biggest company ever. Giants like Nvidia and Apple are obviously much larger, but this is for sure the biggest single cash raise we have ever seen.
To wrap our heads around how this actually works, the analyst uses a classic lemonade stand analogy. Imagine your kid's stand makes $100 over the weekend, and you want in. The kid says there are 2 shares and sells you one for $5,000, okay? That's a very expensive glass of lemonade, but now the whole stand is technically valued at $10,000. Crucially, the kid doesn't sell the whole stand. He just sells one slice, takes your cash, and buys more tables and lemons to expand. That totally normal mechanism? That's exactly what SpaceX is doing here, selling a slice to raise cash to build more rockets.
Moving on to Section 2, 3 hidden rule changes. This is where we find the core conflict.
These 3 critical rule changes stack together to create a pretty massive risk profile. We've got index money force flow, early lockup releases, and a timing overlap. And the result of this stack? It creates this highly unique trap where everyday retail investors might be buying in at the exact same moment early insiders are given an unusually early, wide-open door to sell their shares.
Which brings us to Section 3, the buy the pop trap. Consider this a historical warning.
The analyst definitely brings receipts to back this up. Just look at what happened to other incredibly hyped companies when early investors were finally allowed to dump their shares onto retail buyers. Robinhood fell 92% from its top. Coinbase dropped 92%. Rivian, which is basically the ultimate cautionary tale here, had a massive pop and then plummeted 95%. Now, the analyst's point isn't that SpaceX is doomed. Not at all. His point is that buying the pop is exactly how retail investors get burned on heavily hyped stocks.
Now, here's the wild lockup twist for SpaceX. Normally, insiders are locked up for many months, sometimes even years, right? But according to the filings, SpaceX insiders can sell up to 20% of their shares just days after the first earnings report. We're talking literally weeks after the IPO. Plus, there's a performance trigger. If the stock price goes up 30%, they get to sell an additional 10%. Basically, the more the stock goes up, the more insiders are allowed to sell into the frenzy. And this creates what the analyst refers to as the overlap. Because retail buying and insider selling will be happening at the exact same time, the stock might just kind of drift sideways. Sure, it reduces that classic pump and dump cliff where everybody dumps at once. But it also means if you came for the massive wave up, you probably aren't going to get it. Every wave of buying simply gives insiders more room to sell into it and cap the price.
Let's jump into Section 4, the float multiplier twist. This is all about mandatory buying.
Thanks to a fast entry rule, SpaceX can completely bypass the usual months-long seasoning period and join the NASDAQ 100 within just 15 trading days.
This is absolutely critical because it forces passive index funds to start buying the stock almost immediately, regardless of what the price is. They literally have to buy it simply to match the index.
So the crucial point here is visualizing this massive imbalance. Out of a targeted $2 trillion market cap, SpaceX is only offering about $75 billion in actual shares. That means the public float, the actual amount of shares available to trade out there, is less than 3% of the company. A staggering 97% is locked value.
Normally, an index requires a minimum float of around 10% so that mandatory buying doesn't just overwhelm a tiny supply and artificially rocket the price up. But to get around this, NASDAQ is reportedly applying a float multiplier. This means the index will look at that tiny 3% supply and treat it as if it were 2 to 5 times larger. The direct effect here is that passive funds are mandated to buy 2 to 5 times more stock than the actual real-world supply would usually justify.
And this brilliantly illustrates the seesaw mechanism the analyst is warning us about. On one side, you have artificial multiplied index demand pushing the price higher. On the exact other side of that seesaw, that rising price directly provides the liquidity for early insiders to sell their newly unlocked shares. It's like a giant puzzle, and the pieces interlock perfectly to give early investors a smooth exit.
Now, to keep things perfectly objective here, it is absolutely vital to note the caveat. The early selling structure we just talked about, it doesn't apply to Elon Musk himself. He, along with a few other large investors, remains strictly locked up for 366 days. So, this specific mechanical setup isn't some personal, immediate payday for the CEO, but rather a mechanism seemingly designed to reward those early investors who funded the company years ago.
Finally, Section 5, your IPO survival guide. Let's look at the macro view.
The analyst steps back here to look at historical patterns. When we see massive surges in IPOs, like the staggering 347 we saw in the year 2025 alone, it often serves as a late cycle signal. Just look at the timeline. Surges happen right before the tech bubble burst in 2000, right before the 2008 financial crisis, and during the 2020 to 2021 easy money bubble. He notes that while a crash isn't necessarily imminent right now, historically speaking, massive booms and rushes for the exit very often precede busts.
So here are the analyst's clear survival takeaways. Number 1, do not buy simply to flip the pop because the overlap will likely cap your upside. Number 2, don't short big index names thinking they're going to drop to make room for SpaceX. The reweighting is just spread too thin. Number 3, understand exactly what your automatic passive funds are buying for you because they are likely being forced to buy this. And number 4, consider waiting. History shows you usually get a chance to buy at a saner price later, once the early sellers have cashed out and the dust settles.
Knowing all the hidden mechanics under the hood of this historic event, the fast entry, the early lockup releases, the float multipliers, you have to ask yourself a very serious question before diving in. Is everyone is buying it truly your best investment thesis? Take the time to understand the structure, be smart, and don't blindly become someone else's exit strategy. Thanks for learning with us on today's Explainer.